What's going on, everybody? Welcome to Forex Trading for Beginner. This is a free course that I created to help you start in Forex trading journey. So this is for you if you have no Forex experience or you want to learn more about Forex trading. You don't know where to start. This is for you. We will talking everything you need to know about forex trading, whether you are beginner starting from scratch or have some knowledge. And we will get deeper and deeper into the course, and you will able to level up your forex trading skills. Of course, my hope at the end you will have a strong foundation. What's going on, everybody? Welcome to episode 1. This episode I'm going to talk a little more about introduction of forex trading. This video we will learning for what's a forex, who trades forex, and benefits of Forex. Let's start. What is a forex and how does it work? Forex is a simple little process of exchanging currency with another currency. The forex market is open 24 hours 5 days a week. For example, let's say a person is traveling to Japan. He will exchange his US dollar for Japanese yen, so he could pay for the things he needs when in Japan. The business sector, products and services may come from different countries. Let's say a US car company may import parts from Japan. Let's have to pay the products in Japanese yen. So again, the exchange is required, which is usually done by the company's bank who trades forex, central banks, corporation and retail traders. Let's explain each one. Central banks representing their national government. For example, from September 2011 to January 2015, the Swiss National Bank (SNB) took similar steps with the Swiss National Bank, established a fixed exchange rate between both the Swiss francs and the euro. This prevented the Swiss franc from strengthening beyond the point where other European importers of Swiss goods could accept it. Banks represented interbank market. Banks of all sizes trade currency with each other and using electronic network. In this market, corporations, import and export company uses forex to pay for their goods and services. Consider a German solar panel manufacturer that uses American component and sell its final goods in China. The producer's Chinese yuan must be changed back to euro after the final sale. German company will have to convert euro to dollar in order to purchase additional American components. Retail traders is like me and you. A retail trader is a person who invests their own money but doesn't do it for a living. They buy or sell. Forex low transaction cost, a 24 hours market, leverage and trading options. Let's explain each one. Low transaction cost. The retail trader transaction cost is typically less than 0.10% under the normal market condition. 24-hour market, there is no waiting for the opening bell. From the Monday morning opening in Australia to the Friday afternoon close in the New York, Forex never sleep. Leverage. In a forex trading, a small deposit can counter a much large total contract value. Leverage gives the trader the ability to make nice profit and at the same time keep risk capital to a minimum. Trading option. Forex market provided traders with a wide variety of trading options. Traders can trade 100 of currency pairs, different strategies and different indicators.
What's going on, everybody? Welcome back to my YouTube channel. Today's episode will be talking for Forex terminology or a Forex language. This video we will learning for currency pair, bid, bid and ask price, spread, leverage, margin, lot size, finally long and short position. So let's start. Currency pairs. Currency pairs is a simply the exchange of one currency matched up against another. For example, Euro USD. Euro is a base currency matched up dollar or USD currency or the second currency paired. BIP BIP standing for percentage in pound. So what is the BIP? BIP meaning the measurement used to express the difference in value between two currencies. So BIP will showing the value between two currencies. For example, BIP we calculate for 4 decimal or 2 decimal. All USD JPY are 2 decimal, others are 4 decimal. For example, Euro USD 4 decimals. If the price moves 1.10252, 1.1035 is equal 10 pips. It means the market rise or increase it. How to get 10 pips? We subtracted for the last 2-digit numbers. 25, 35 means 10 pips. If the price moves 1.21035 to 1.21025 means 10 pips will be decreasing. So 35 minus 25, 10. Market price make decrease it. Second example, USD JPY 2 decimal. If the price move is 106.20 up to 106.40 equal 20 pips, means market increase it. So 20 is 40, 20 pips. If the price moves 106.40 up to 106.20 is equal 20 pips. The market mix decrease it. We subtract about the last 2-digit numbers when we want it to calculate pip. Let's continue. Bid, ask price, and spread. Let's discuss it. The bid price means the currency you're willing to sell it, and the ask price is the currency willing to buy it. Why you did it? When you make a sell a currency, you sure that currency will be strongly, and when we buy in a currency, it's showing this currency will be weakened. The difference between the bid and ask price is called spread. Let's show it for the images below. This will show in the bid, I willing to sell this currency, and this showing for ask price, the currency I willing to buy it. This is the full image showing what I mentioned above. Currency pair, ask price, bid price, and a bid spread. Leverage and margin. Leverage means the ability to buy or sell large amount of an instrument using small amount of your own money. So there are different leverages. Leverage is depending on the broker you use it. There is different leverages, 1 to 100, 1 to 10, 1 to 5, 1 to 6. So leverage means the ability to buy or sell large amount. Because of you have a small account for 100. When the broker gives 1 to 100 leverage, it means you have a buying power for $10,000. If the price, for example here, let's say your account has a 1,000 capital. If the leverage is 10 to 1, you can open a position size for 10,000. It means you have buying power for 10,000. If the leverage is 1,000 to 1, you can open a position size for $100,000 or $100,000 buying power. Leverage, it means the amount of money your trading account or the amount you deposit your small account. Here you deposit amount for 100, and this is the leverage gives the broker 1 to 100, and the result is a 10,000 gives 10,000 buying power. That is the leverage and emerging. Lot size. Lot size is a unit to measure the amount of the deal. There are four main tables of lot size: standard lot size, mini lot size, micro lot size, and a nano lot size. Standard is the hugest lot size, and nano is a very small lot size. Micro is a little small. Mini will be mid and middle. Yeah. For example, assume you wanted to buy a standard lot for 10,000 units. For example, lot size. Lot size is the amount to measure the amount of the deal. There are four main tables of lot size: standard, mini, micro, and nano. For example, assume you wanted to buy a standard lot for 100 units of pound dollar or JPP USD. The exchange rate is 1.24 that moment, meaning you will pay USD 1.24 for 1 British pound. If you want 1 British pound, you pay 1.24 dollar. What will happen is that you will purchase 100 pound units with $124,000. Long and short position. Long and short position refers market direction. Where is the market going, up or down? Long means buy bullish market. Short means sell or a bearish market. So thank you for joining this video. What's going on, everybody? Welcome back to another video. Today's episode 3, we will discuss in four currency pairs for forex trading. This video we will learn in four major currency, cross currency, exotic currency. Let's discuss it. Currency pairs can be divided into three categories: major currency, cross currency, exotic currency. Major currency simply meaning US dollar currency, also saying it is basically the currency which is the most traded in the world. Cross currency, non-US currency. Exotic currency refers to currency pairs for developing countries. For example, Turkey, South Africa, and so on. Major currencies. These are major currencies or US dollar currency. For example, Euro dollar, Pound dollar, Aussie dollar, Kiwi dollar, dollar Swiss, dollar yen, and dollar loni. And also here the image for the flag and the currency. Cross currency means non-US dollar. So Euro, JPY, JBB, CAD, AUD, NZD. These are six and then US dollar currency. Each one has another currency pairs. For example, Euro JBB, Euro CHF, Euro CAD, Euro Aussie, Euro NZD, Euro JBB, JBY. So every currency has another currency pairs for non-dollar. Exotic currency means developing country currency. For example, USD SGD, US dollar Singapore, Euro Turkish lira, US dollar Swedish crown, US dollar Norwegian, US dollar Danish, US dollar South African or USD SAR, and finally US dollar Hong Kong dollar. What's going on, everybody? Welcome back to another episode. Today's episode we'll be talking for forex trading session. Before we start in this episode, if you are not watching for the last preview, please go back and watch it. This episode we will discuss in for forex trading session. Best session is to trade forex. Best days to trade forex. When not to trade forex. And finally, recap. Forex trading session. Forex market can be broken up into four major trading sessions: Sydney session, Tokyo session, London session, and New York session. These are the four major trading sessions in the Forex market. Best session is to trade a Forex. London session, London and New York overlap is the best time to trade a Forex. Because of this time, the market has more volatility. Best days to trade a Forex. The best days to trade a Forex is Tuesday, Wednesday, and Thursday. Because of this day, market has more volatility. Monday, the market will be preparing, and Friday, the market started to close it because of the weekend. So the best days to trade a Forex: Tuesday, Wednesday, and a Thursday. When not to trade a Forex? This time not to trade a Forex. Don't trade Forex because of bank holidays. Bank holidays, banks are the market makers. If the bank is a holiday, no one makes market because if you are a retailer, you don't make a market. Friday afternoon and weekend, these times not to trade. End of December, this time all the banks are holidays. When angry or frustrated, at this time, if you are trying to trade, you make a wrong decision because of you are not stable, you are feeling more angry. So this action is caused to take a wrong decision and blocking your account. Essentially, this time the market has no volatility because of Asian session is a low volatility. Releases of news events at this time don't trade because of no one knows what will be the news, positive or negative. You trying to trade this time, maybe make loading your account. Market closing time overnight because of all the market are closed. So this time not trade. Be patient and stay out of the market. And finally, we trading session, Sydney session, London and New York. London is the most volatility trading session. Tuesday, Wednesday, and Thursday are the most volatility trading days of the week. What's going on, everybody? Welcome back to another episode. This episode we will discussing for tables of forex trader. This episode we will discussing for scalper trader, day trader, swing trader, position trader. Tables of forex trader. There are four main different tables of forex trader: scalpers, day traders, swing traders, and position traders. Scalpers. Scalpers hold into a few seconds to a few minutes at the most. Their main objective is to grab very small amount of PBs as many times as they can throughout the busiest time of the day. Day traders. Day traders only enter the market once and only once in a day. Swing traders hold into their traders for a couple of days, sometimes week, sometimes 2 weeks. Position trading is a long-term trading lasting a couple of months to several years. They hold 2 years, 6 months, 5 years. Recap. Tables of traders, scalpers, position open and closed within seconds or minutes. Day traders open and close trade on a single trading day. Sometimes day traders they took 1 or 3 trades per day. Swing traders typically hold trades between 1 to 4 days, sometimes 6 days, 7 days. Position traders hold trades for months or even years.
What's going on, everybody? Welcome back to my YouTube channel. Today's episode we will discussing for episode 6 how to read charts in a forex. Please, if you are not watching for the last 5 episodes, please go back and watch it. This episode we will discussing for line chart, bar chart, candlestick chart, benefits of candlestick chart, and finally recap. How to read charts in the forex. Before we start in how to read, we must know what is a chart. Chart is simply a visual representation of a currency pair prices over a period of a time. So chart is a telling the past of the chart is means what will happen it before. Forex charts can be divided into 3 categories: line chart, bar chart, and a candlestick charts. Line chart. Line chart is the most basic of all forex charts. Line chart can give the trader an idea of how the price of a currency has changed over a given time frame. So line chart is a gives the change of time frame, for example, 1 hour and 30 minutes. How the currency prices will change it only gives that. Bar chart. Bar chart is a visual representation of the data. The highs and lows, as well as the opening and closing price, are shown. So another bar chart is only telling for the chart is where to open or close it, only telling that, or only showing for high of the price and lower of the price. Candlestick charts. Candlestick charts provide the same price data as a bar chart, but in more visual appealing manner. So bar chart and a candlestick telling same thinking, prices high and low, but the difference of candlestick is this:
Here is an upper high, lower high, or low of the day, high of the day. This is the real body, the body of the candle, closer where the candle closed, where open candle. This green called Polish candle. We will learn it. This is red body or bearish candle. Higher of the low, high of the day, low of the day. Bearish close it here, candle close it here, open it here. So this will different budget because it tells us we're showing for body. Benefits of candlestick charts. Candlesticks are simply to read and comprehending, making them an excellent spot of beginner to start learning about chart analysis. So, benefits of candlesticks, you must learn in the candles when you make analysis. You must know where the candle open, close it. Candlesticks are a symbol to operate the information in the part notation adapted to your eyes and nearly instantly. Plus research suggested that image aided learning, so it's possible that they all aid trading as well. So another benefit is every day when you make an analysis, your eyes will be adapted to candles, so easily understanding where the price is going or where the price will be falling or upping. So everything happening in the candles, you will be adapted as a naturally when you practice it every day, sitting and showing what happening candle is doing it. Candlesticks are excellent in detecting market reversal, such as from uptrend to downtrend or from downtrend to uptrend. So if you are adopted candlesticks, so you must know when the market making down or up. So it means when the market makes reversal. So you know where the price make a reversal because of you making practices and adapted it candlesticks. So that is the benefits of candlesticks. Recap. Tables of charts, line chart is like this. They only showing the prices. There is no showing open or closing. They only showing where the price is going up or down. Bar chart is only telling higher and low. Candlestick chart is showing for price open, closed, and a body of the candles. So these are the charts. So if you are technical analysis, you only trading view using line chart or bar chart or currency. But the most of all forex trading uses a candlestick chart because of is a clearly and a telling the real thing is or clearly what happening in the past prices. So please, thank you for your support in the channel. If you are new, welcome, subscribe, smash like button. If you are enjoying the content, see you again. Thank you. What's going on, everybody? Welcome back to my YouTube channel. Today is episode 7. This episode will be talking tables of Forex order. Let's start. Outlines. Market order, limit order, stop entry order. These orders will discuss in this episode. So tables of Forex order. Before we jump in tables of Forex order, firstly we must know what is an order. An order is a proposal to open or close a transaction using your broker trading platform. If the instruction is specified by you as satisfying the term, order refers to how you will enter or exit a trade. So simply meaning order, how you will enter or exit a trade. So orders are divided into two categories: market order and pending order. What is a market order? Market order that is immediately executed against price set by your broker. Pending order, an order that will be executed at the price you specified at the later time. So market order is a similar meaning when you enter at that trade, when you sit in your computer, at that the price will be executed immediately taking that trade. So pending trader, you feeling this time is not possible, but you feeling to be busy and the price will go in, will reach in and key levels. So you making a pending order. So you enter later time when price reach it there. We will see for examples, more examples. Market order. Market order is an order to buy or sell at the best available prices. So, for example, the bid price for Euro USD is currently at the 1.2140 and the ask price is at 1.2142. So ask price and bid price we will learn it for the last episode 2 forex terminology. So if you wanted to buy Euro USD at the market, then it would be sold at the price of 1.2142. So you would click buy and your trading platform would be instantly executed buy order at that over exacted price. So here is the Euro USD buy and a sell order. So you enter stop loss and target profit, then you hit the, if you are satisfying buying or you're going selling, will be hit automatically, traded will be opening. Limit order. Limit order is an order placed to either buy below the market or sell above the market at a certain prices. So limit order, pending order means limit order. So buy limit and a sell limit. Buy limit. So order places below the price and price then goes up. So you believe it, price is going. You feeling price will be back in here, and this time you are not monitoring your computer. So you feeling to be busy or have a class or have a meeting. So you making a buy limit here, then the price is reaching here, automatically trade open it buy. Sell limit is a vice versa. You feeling the price is going up and you feeling price is back in key level. At that time you are not monitoring your computer, so you feeling to be busy or having a class or everything you will think to be busy. So we'll be making a sell limit in here when price is making going here, then automatically is open sell limits, and that opportunities will be taken. These are in order to buy or sell when the market reaches the limit prices. You place is a buy limit order to buy at the below the specific price. You place is a sell limit order to sell at the specific price or better. So limit order and a so buy limit and a sell limit is a bending order. So price is feeling to going and will be back in here and making a buy limit order. When price reaches here, automatically is opening. Vice versa, sell limit, price is going down, You're feeling to be back here, key level, and then we will be busy. So making a sell limit, the price automatically is open sell order. Example. For example, Euro USD is currently trading is 1.2050. You want it to go short if the price reaches 1.2070. You can either sit in front of your monitor or waiting for to hit 1.2070. At the which point you would click a sell market order. So at this time you are monitoring the computer and you are sitting there, or you can sell limit order at 1.2070. Then you would walking away from your computer to attending your classroom, dancing class, meeting class, everything you will be paid. If the price goes up 1.207, your trading platform will automatically execute a sell order at the best available prices. You use this type of entry order when you believe in the price will reverse it up in hitting the price you specific. So if you are feeling to be patient using sell limit or a buy limit. Stop entry order. Stop entry order. Stop entry order is an order placed to buy above and the market or a sell below the market certain prices. So buy stop and a sell stop. So buy stop. Order placed above price and price keeps going up. So here, this example, this image will show me. You feeling the price is going up. I'm breaking the key level in here, for example. You feeling the price is never stopping. Price is going up. So making a buy stop when prices came in and then will continuously, then automatically buy stop. Taking a buy order. First is a sell stop. You feeling price is going down and hitting the key level, prices will automatically sell order. You place a buy stop order to buy at the price above the market price and restrict it when the market price touches or goes through the buy stop prices. So symbol in here example, prices stopping here, price going up, breaking here, and prices when hitting here, then the order is opening. Vice versa, price hitting here, automatically is open. You place a sell stop order to sell when a specific price is reached. Example. For example, pound USD is currently trading at the 1.5050 and is heading upward. You believe its price will continue in direction if it is 1.5060. So you get 10 pips. Stop loss order. Stop loss order is a tab of order linked a trader for the purpose of preventing additional losses if the price is going against you. If you are in a long position, it's a sell stop order. If you are short position, it's a buy stop order. So if you wanted to use this, sell it in long using a sell stop, buy stop. So thank you for you watching this episode. Please, thank you for you watching this episode. If you are new channel, welcome. Smash like button if you are enjoying the content. See you again. Thank you. What's going on, everybody? Welcome back to my YouTube channel. Today's episode 8. This episode we will learning for market analysis. This video we will learning for fundamental analysis, technical analysis, sentimental analysis. Let's start. Fundamental analysis. Fundamental analysis is a type of analysis that connected to understanding the country's economic condition and how it will impact the value of the currency. Let's look at the different things that you should consider to understanding the fundamental of economic market. Interest rate. What is the interest rate? Interest rate are what the local bank is charging for the loans and a giveaway for the deposit. For example, when a person avails a loan, he will end up making the banks richer and thereby contributing to the country's economic. Employment statistics. Employment statistics of the country will also have direct bearing on the value of the country. Employment contributing to the economic in two ways. Firstly, it will give people buying power, as more salary will be donated out to the crowd. The other way that the people will buy the different goods and services, thereby contributing to the growth of the economy. So you have to look at how many people are employed in the country and also check the number of unemployment. So more employment, it means shows for the sign of value of the country was strongly. More unemployment is sign of a weakness of the currency. So it's a vice versa. Gross domestic product. Gross domestic product, GDP, refers to the per capita income and overall money that country collective earning. You have to look at the GDP of the country to see if the currency will do well or not. There is a different opinion on how the GDP of the country has to be asserted. Some of the opinion that rises on the GDP is a good sign of the economic stability. On the other hand, some look at these bad things as it will the consumer goods prices rise, which will again the impact of the currency value negatively. So good GDP is a showing for strongly currency. Political causes. Political causes that can affect the value of the currency. For example, if there is an election or if there is an protest, then it will have an impact on the value of the currency. You have to watch the news regularly to avoid it with any such changes and preparing for it. If you think a political abroad is going to cause the value of the currency drop, then you have to deposit it over the earliest. Natural causes. Natural climates that can impact the value of the currency, including earthquakes, tsunami, and etc. You have to read the newspapers regularly to know these are the remaining prepared for any price changes. All these are looking for fundamental analysis and will impact the currency of the country. Let's continue. Technical analysis. Technical analysis is a strategy of looking into past price movement, both recent past and a couple of months or years past, to determine where the current price is headed. So simply, technical analysis is used to determine where the price is going, where or price is going up or down. For example, this is all trending. We're looking for the last mountain. The last month, the market was going up, and the next 2 months, the market was consolidation or a range. And then we will looking for to decide if the market is going up or down. So we must waiting when the price break out the boundary of this line and finally showing new trending and showing for the market is going up. Technical analysis will help in that to understand it. Technical indicators. Moving average indicator, exponential average indicator, moving average coverage diverse, relative strength index, percentage price oscillator indicator, parabolic sign indicator, average directional indices. All these are indicators using when using technical analysis. So these indicators are all different. Every indicator has a different as a tools Others has another tools. Next, main types of technical analysis: price action, technical indicator, classical chart. Technical indicator, we were talking for the last previous slides. What is a price action? Price action is symbol meaning candle formation. It's one of the strategy used money traders in the forex industry market. Sentimental analysis. Sentimental analysis refers to understanding the mood of investors and the market as a whole. So simply, it uses more investors. If the market has more investors, so the market is moving well and has more volatility. If the market has less investors, the market don't make a movement. So sentimental analysis helping to understand this current have more investors or less investors. That is what will help him. Thank you for your watching. If you are new to the channel and join the content, please smash like button, subscribe, turn notification to receive it the next episode. Thank you. Good luck. What's going on, everybody? Welcome back to another episode. This episode 9. This episode we will learn for getting started with the forex. The last previous episode we will learn for meaning and a concept of forex trading. This is another episode. This episode we will learn for two things: basics of forex and specifics. Basics included for laptops, internet, trading account or online account, and a software. Specifics we will learn for forex broker, information is forex journal, and a currency charts. So let's start. Laptops. The first and most specific things that you will require to trade in a forex is a laptop. You have to buy one and use it only for foreign for trading purpose. Laptop is important thing. It helps you to analyze your market. So you don't need to buy a expensive laptops. So only you need it a laptop only using for purpose. The next thing is internet. The next thing is reliable internet connection. As you know, the internet is the most important aspect of trading. You need the internet to look at the rates, also buy and sell the currency. So internet is one of the most important things. So everywhere you live is if you have access to internet, you can invest or you can trade in the foreign exchange. The next thing is a trading account and online account. The next step is to open a trading account. Trading account should be specific to forex trading. You call up the company that deals with it and ask them to help you open an account in softwares. There may be some software that the company official will download in your system. You have to allow them to do that as it what will help you to trade. So you need some software using to trade it. So included MetaTrader 40 and trading views. That software will help you more. Specifics included for forex broker. The first specific things to find yourself is a broker, is a forex broker. A broker is the one who will help you buying and selling for foreign currency. There are more and more forex brokers. This picture will show some of the companies of the Forex broker, including for FX Premiums, FX Pro, Hot Forex, Iron FX, and other market.com, XE Markets. So these are Forex brokers. So the choice is you. The one you needed to open an account is depending for you. Information. The next step is to gather specific information about Forex trading. Foreign exchange is a subject that requires you to connect some research, and only then will you be able to connect it in a daily basis. The information can be acquired through these books or these episodes 1 up to 9. This market information, you needed to find some information extra. So you find in some other traders making researches, reading more books, watching different videos to get information to pushing to be best forex trader. So information is that forex journal. Forex market is a quick volatile. You have to understand it, how it works, and also pay attention to all your traders. In order to arrive at a winning strategy, you have to maintain a record of all your deals. So you needed to maintain, record all of your deals, all of your trades to take it. So to know it, where trade is the healthy, what currency is good, how can I use it, my risk management, how it works, my strategy, all these to know when you make a record and your everything is to take in or everything is about your trades. So forex journal is a very important thing. The final thing is a currency choice. The next step is to pick the currency. The currency should be chosen in Paris. So we know in the forex industry have more and more currency. So you needed to choose some of that currency to be good trader and make money. So you needed to choose some of the currency, including Euro USD, Pound Dollar, Aussie USD JPY, USD CHF, USD CAD, AUD USD, NZD USD, and other currencies. So you needed to choose some pairs to be traded. So thank you for you watching this episode. If you are new, please smash like button, turn notification,